Greetings, everyone. So welcome today to our monthly webinar. So Wednesday, June 17th. So thank you again for joining us. It is summer, so we are well into summer and the weather is very warm and comfortable. But as hot as the weather is, it looks like the capital markets are equally hot. So this is an interesting thing that we have not seen for a good number of years. We have not had such lively, hot IPO action for a while. It's been a little bit quiet in that front. There's been a lot of M&A activity, but big marquee IPOs, we haven't had those for a while up until last Friday. So as we have been very busy with this, this has gotten our wheels turning and have ideas for estate and tax planning for these unicorn shareholders, and that may be you who are joining us today. And really, it's thinking through these particular persons and individuals for what needs to be done or what should be considered before an IPO or tender offers or acquisitions for this significant appreciation for estate taxes, income taxes. What should we be doing? So this has become the activity of my summer for summer 2026 because there's a lot of activity here. So let's take a look at our first slide as we move through here. So move on to the next one here. So just a little bit of our agenda. So we'll talk about why unicorn equity is a little bit difficult to plan around, how to shift future appreciation outside the taxable estate before the exit event, the ideas of trust and gifting structures for these pre-IPO or restricted shares. So we'll take a look at that, coordinating QSBS, and some problems that can happen for this planning. So one caveat before we get started here is that, of course, this is for academic, informational, educational purposes. Please do not engage in transfer tax planning because you saw someone on the internet. You're going to need extensive counsel to do this. In fact, I think this seminar will indicate the things that one has to do, and you will start to realize, gosh, this is a little bit complicated. Well, when it's a little bit complicated, just have someone help you. Just have someone help you and guide you through the process, because we're going to see this is a little bit different than dealing with some other assets. So let's jump right into it for our agenda. Let's jump into our next slide here. So why is this unicorn equity, these special companies, is this uniquely difficult to plan around? So the first thing that is one of the major hurdles is what we have in our upper left-hand quadrant here, the illiquidity and transfer restrictions. This is a gatekeeper. This is a threshold issue. And for many of these companies that we are encountering now, many of them are in AI, many of them are space, many of them are in these related areas. What's the issue with these companies? What's the problem as a holder of these? The first thing is that the shares are generally private, and they're privately held by the company books, and there may be lockups or restrictions on these. So what does this look like? So if I'm an employee, is there a company right of first refusal? Is there a board consent requirement? Are there consensual transfer restrictions? So are there restrictions on who I can transfer it to? And how do I actually move this? So right out of the gate, thinking for either estate tax planning or income tax planning, the first thing that we got to think about is, can I even transfer this thing at all? There are some situations where I may be a founder of a company, I am a covered employee for SEC purposes, and because of that, there are going to be transfer restrictions, or there's going to be a very significant and cumbersome process that I have to go through with the company lawyers, particularly the company security lawyers with the SEC, because when we transfer stock, and eventually there's an IPO, the SEC wants to know exactly who the owners are. And that's a really cumbersome process. And the idea of saying, well, I'm just going to change all of this, the securities lawyer saying, do you know how much work that causes us and how many things we have to do when you try to do that? You need to tell us way, way in advance that you're going to do this. So the other things that can come about where the company is private is there are sometimes things like the company rights of first refusal. The company has a right to buy this before I sell it. How do you deal with that? That's going to be something you have to look company by company. People may say, well, what does that matter? I'm gifting it. Well, if you're gifting it, maybe it's okay. We'll see transfer restrictions. Maybe that's going to be a problem. But gifting it, maybe you're okay. But what if I'm trying to do an IDGT plus sale? I'm selling it, and I'm selling it, and I'm selling it in what looks like flagrant violation of the transfer restriction. But I'm selling it to myself, my own IDGT, my own covered family member. Is that okay? Is that not okay? Well, you have to dig into this. So this is the first thing for clients that have this and families that have this is, can you transfer anything at all? This is the first thing that you've got to figure out, because right out of the gate, the great plan that you'll hear about that says, wow, I love this. I'm going to do this sale to the IDGT, or I'm going to do a GRAT, or all of these things. It's going to be great. I'm going to save so much estate tax. Oh, this is great. And then you go to the company, and this is the worst thing, and why to do it the wrong way. You hire us, the lawyers. Of course, we would stop you from making this mistake, but others, you'll do all of this planning, all of this work, and then you say, okay, and for the finishing touch, I'm going to do the transfer. HR company, please change the stock on the books. And they say, you violated the right of first refusal, or you violated the transfer restriction. We're not going to approve that. Or they'll say, okay, we'll approve this. You're in a rush. And they'll say, yeah, we'll approve it. The board meets once a month to approve these things on a consent calendar, and they do it on, the 15th of every month. So you're not going to get this done until July of next month. This we have to think through, because there's a lot of considerations on, can I move it at all? What's the process of moving it? Are there certain restrictions? And what's the timing of it? Can I get it done in time? A recent one that I've been finding for certain AI companies is that they're not allowing grats. They just don't want grats. Kind of a puzzler as to why. I think it's because they're worried that a minor is going to own the shares because of the way a grat works. They're more comfortable with the IDGTs. But I've encountered this in 2 cases now for pretty well-known companies. They say no grats. And then we followed up and said, well, what about a sale to an IDGT? And then they said, yeah, that's fine. Just no grats. We have some problem with grats. Well, there, now you know. So that's the first thing that is difficult from planning compared to other assets. Like if I just have a publicly traded stock portfolio, I can transfer whatever I want. I just do up the trust. I do up all of these things. I have my trustee. I have the account, and I could just move the shares just via the brokerage account. It's just automated. It's no problem. Real estate, I just execute a deed. I move it over, no problem. Real estate, there may be transfer taxes or local taxes I have to watch out for, but the process is easy. Unicorn stock, the process is not that easy. There can be little hidden gremlins in this thing. So illiquidity, transfer restrictions, you got to take a look at that. In addition to that, we have to take a look at what's the value of the transfer. So we always want to do this as early as possible. I always give this metaphor. One time my son, we were at the party planning store, and we saw another dad was really throwing one heck of a birthday party and had all of these balloons, and they were all inflated. He's trying to stuff the balloons into this car, and he can't get all the balloons into the car, and he looks very, very puzzled and how he's going to get all of these balloons to the party and yet have the size of the car that he has. And my son, and even though he was very small, kind of looks at me and says, why didn't he just buy the empty balloons and blow them up at the party? I said, I don't know, but that's what you should do. That's what you should do for this. And that's what the objective of this is that we're trying to move the stock. We're trying to move the asset before the balloon inflates. We're trying to move the uninflated balloons and let them inflate inside the trust. Problem. What's the problem with this? The valuation is uncertain. And the valuation is uncertain because there is no public market for the shares. Just like mentioning before with illiquidity, if I was transferring publicly traded shares, I have many people transfer publicly traded shares to IDGTs, to CRTs, to GRATs, to all of these different things. Well, the IRS says if there's a public market for it, you take the high and low and you average it. You just use that. The high and low of the day that you transfer it, that's the price. And it's the average. So there's just a valuation methodology. And they say there's a public market, the price priced in. So you don't need an appraiser. You don't need anybody. You just calculate it. It's very simple. But it is not that way for private company shares. It's also not that way if I own the private company shares, if I'm not an employee for the company, if I am an investor and I own through a special purpose vehicle, I'm going to have the same issue, is that there's a special purpose vehicle in between the shares and there is a valuation question here. So with this, you're going to need to hire an appraiser. There's really just no way around this. You're going to need to hire a qualified, good appraiser. Client after client after client says, I've got a 409A. That's an appraisal, Mike. I'm going to use the 409A, or I'm going to use the last preferred pricing round. That's not going to fly for gift tax purposes. That's going to get kicked right back. They're going to say that's no good. The considerations for doing a 409A and for doing a fair market value appraisal are different. And the 409A, that sort of appraisal is not going to work. You're going to need an actual appraisal. Why do you want this? A couple of reasons why you want this. Number one, I need to know how much I'm giving into the trust. There's a planning consideration here. There have also been judicially created techniques from famous cases like King and Wandry and Peters, famous cases that came out that basically said you can, when you're using good faith appraisals by professionals, you can create formula clauses for sales and gifts to prevent overfunding. And there are techniques of how the lawyers can draft your transfer to the trust in an appropriate way using those judicially created methods so that if the appraisal is wrong and I'm over, I don't have to pay gift tax. There's, of course, there are some cases that are that one has to avoid, like Pierre and Powell and other ones. You don't want to be doing planning like that because those were failed ones. You have to go the other way. But the valuation, a good faith valuation, goes a long way for being able to use those clauses to dial in the right amount of funding the trust that is reliable, predictable, and if the IRS comes back and says that appraisal was way off, our appraisal is a lot higher, and then if you say, okay, well, we're going to get another appraisal, we'll try to figure this out, and we end up high, we don't want to accidentally cause gift tax. Well, we got a solution for that in a Wandry, King, Peters, et cetera clause that we'll have already pre-set up, and that will render the gift okay. If the overage will likely have to go to a charity, or it may have to go to a spousal trust or something like that, depending on how we design it. But using that valuation is the hook, the good faith valuation, that I can use that. If I just wing out an idea, if I just say, well, it's probably a little bit higher than the 409A, I don't know, 30%, well, I'm just making stuff up. Well, if I do that, then none of those judicially created methods are going to work, and we could have a problem in the gift funding of the trust. So valuation uncertainty, that's a special thing for this. The other thing that is also complicated for this is this concentration of the stock and cash mismatch. So this is another concern here for when we're funding the trust, is we really have to look globally at our particular client, globally at you, and see, well, how much of your worth is this? We're having a number of clients from the marquee AI companies that the numbers are just staggering. They're shocked. I'm shocked. The numbers are huge, but the numbers are all based on the 409A and the appraisals. There's no, money yet. So a lot of it is estimates, and we have to again think through that. Thus far, a lot of this money is paper money, and we have to dial in, various scenarios. What if it hits over? Like, looked like SpaceX was doing pretty good this morning. I don't know how it's doing now, but doing pretty well. They seem to have overshot the underwriter's bid. That's interesting. What if it doesn't do that? Did we plan for that? What if there's significant volatility in 6 months, 9 months, a year? What do we do? So there's that. And then the last thing in our lower right-hand corner, this appreciation runs against you. Why are people in a rush to do this? Why are people considering this? Is because estate tax exposure is lowest today. The estate tax exposure is the lowest when the public market, the liquidity event is remote. That is the way where you can get the lowest valuation and you have the safest transfers. There are risks from other judicially created doctrines, such as the assignment of income doctrine, that if I plan the transfer the week before it goes public, and it's certain to go public, and I time the transfer right then, there can be an issue that I'm assigning income to the trust, and I'm basically just steering it over there. That is less of a concern for, let's say, an IDGT, but it is a concern for a QSBS trust. IDGT, it's like, oh, you assign the income over there. Okay, well, income tax-wise, it all flows back to me, so there's not a big issue there. Estate gift tax-wise, maybe, but that's going to go more on the valuation of the asset. So that could cut both ways. So this appreciation runs against you. This creates a bind. And I have this with every client, is they say, well, going back to the valuation uncertainty, I don't know the size of this thing. How do I fund the trust? Should I give 90% of it to the trust, 50%, 30%? I don't know. You know when I'm going to know, Mike? The week before the IPO. I say, that's too late. That's too close. There's number one, there's no possible way we could get it done that fast. But two, you are too close to the full valuation. You're going to be paying a very high premium, nearly dollar for dollar for that transfer. You need to transfer far earlier. But that cuts against in knowing what's going to happen. So this is, alas, a dance, a balancing act of figuring out, well, I'm getting closer. What point is too close and what point is too far away? Well, I kind of have to live in that gap because that's the area where we can plan more safely. It's also the area where we have the best use of the estate tax exemptions. So let's go on to our next slide here to take a look at some other ideas on this. So what are we trying to do here? We're trying to shift the appreciation outside the taxable estate before the exit. So this is very classic planning. What we're trying to do is the balloon thing. We're trying to move the balloons where they're underinflated and then let them inflate inside the vehicle. This is generally estate tax planning. We'll see in a moment for QSBS, it can also entail gift tax planning, but this is generally for estate tax planning. Why are we looking at this for estate tax planning? Is because the estate tax is a 40% tax, and it is difficult to control because it happens when it happens. Capital gains tax, we're at highest bracket, 20% plus if it's over $200,000. The Affordable Care Act tax, so 23.8, and then if we're in California plus California, 23.8 plus 13, maybe we're at 36% or so. Well, we're still 4% less. We're getting closer, but the capital gains tax, again, we can control. I can control when I sell things. I can't really control when I go. I try my best, but I can't really control that. So that's one of the things that we try to plan. There's also, with this, when we do IDGTs, we can shift the income. If the trust toggles and becomes non-grantor trust, we could always shift it to other generations. So with the trust, we have flexibility and we have choices. If I just keep it all in my big box of my revocable living trust, which hopefully you have a revocable living trust, in the big box of the revocable living trust, I'm kind of stuck. It's all going to tax, going to flow to me. I can't really do much to get it out once it gets large. There is a little bit of a problem here. So again, we're trying to use today's low valuations, all of those things that are a problem that we were talking about, that the company has a right of first refusal, it is non-public, there's no readily available market for it, there's transfer restrictions, you can only give it to family members. Actually, all of that is good for estate tax valuation purposes because it impairs the value of the item. We like that. We want to use that. The other thing that is good right now is that we have very, very high exemptions. So again, nice thing to have 2026. I haven't seen hot IPOs, activity like this. There's going to be probably a good number going this year, and the market also is receiving them well. There's about 8 years ago, there were a number of IPOs, but the market didn't receive them well, and it wasn't a big liquidity event and moneymaker for the company. Now it seems to be that way. That's great. What's also great is we are also in a time of historically large estate tax exemptions. A couple's got $30 million to work with, $15 million for a single person. We're starting to get a magic combo here. Again, you look back, 8 years ago before, maybe we have 5 million to work with. You go back earlier than that, we're working with $1 million. You can't transfer very much of anything. That's why GRAPs were so popular back then, because you didn't have enough estate tax exemption to move around. Now, 15 million per person, we got a lot that we can move around. We can do a lot of things here. So if we already have lower valuations, we have high exemptions, we can do the valuation discounting. This can work very well. And then we can even pile on, if we have big significant holding, we can do estate tax freezing techniques that can not use the exemptions, and we can use some exemption for priming funds. We can keep a little bit, and then we can freeze the value. So let's go towards that. Let's go to our part 3 over here. So moving right along. So what are some common structures that we use for trust and gifting for these pre-IPO and transfer restricted shares? Big three. The big three tend to be the IDGT Dynasty Trust, the GRAT, Grantor Retained Annuity Trust, and then a technique sale to a grantor trust, that's sale to an IDGT. And then we have a little bit note down here is also with QSBS. QSBS, though, is the different one. QSBS, we probably will be transferring that or considering transferring that to a non-grantor trust. And people say, oh, let's sell to the non-grantor trust. Nope, that one doesn't work. That's a taxable sale. So that one doesn't work. But for gratuitous transfers, gifting, I can gift to QSBS trusts. So that's in play. I can gift to QSBS trusts, but sales to QSBS trusts, I have to be careful because that can trigger capital gains. So we have to be very careful with that. But for the flexible vehicles, often we look at IDGT, Dynasty Trust Style, GRAT, or combining 1 and 3, sale to the grantor trust. And why are we looking at these? IDGTs, those trusts, intentionally defective grantor trusts, that in its simplest form is just the irrevocable box. I have $1 million worth of stock. I gift it into the IDGT for the next generation, for maybe my spouse. Perhaps I could do a slat variation of it. Slat, we just have to be very careful. If you look at slats, the devil is in the details for the slat trust. For slat trust, be very, very careful because we're a community property state. So is if friends on, I see some pals here from Washington, we're community property state too. Nevada, community property state. So for those states, we have to be careful with the slat, because if husband just says, oh, or wife, whoever has the stock, wife says, oh, I'll just gift it into the slat for husband, and there's kind of a back door. The question of planners in community property states is, well, did you do the transmutation agreement? And like, no, it was in my name. That means, when did you get married? I don't know, 1990s, or, we got married a long time ago. Before you got that stock? Yeah, way before I got that stock. You granted the husband's property into the trust for the husband. You didn't really do a slat. This is going to all fall apart. So you have to be careful, because community property renders that marital property. If you do a slat, you have to do a transmutation agreement. You have to do a whole family law process before you get into funding the slat. I sometimes see this. I see the little advertisements or little things at various banks and brokerages of, do the slat. The slat's so easy. People say, do the slat. Slat's so easy. You say, yeah, the slat could be a good thing, but community property state. And once sometimes we chat with clients, they say, "Oh, I didn't see any of that in the brochure." It's like, well, yeah, there's only 8 community property states. So the brochure's for the 48 or 42 other states. The 8 that are community property, there's a whole other angle here. Going towards same as for SLAT, that's a version of an intentionally defective grantor trust. What we're thinking between a SLAT, IDGT, dynasty trust, what's the difference between all of these? The chassis is the same, the core is the same. It's what the beneficiary arrangement is. SLAT, my spouse is a beneficiary after transmutation. IDGT, I'll have definable beneficiaries like 50-50 the kids. That's not super great for generation skipping transfer tax purposes. Or dynasty trust, it's like at common law, I teach the wills and trust class. Law students spend all this time in a class called property, and they learn all these ancient methods of property. And one of them was this thing called the fee tail. And the fee tail is when I would convey property, I would convey it. And I say, I grant to you, my son, and the blood heirs of your body. That's what the dynasty trust is. I say, who are the beneficiaries of the trust? The blood heirs of the body of Michael Lee and his spouse. And so IDGT, dynasty trust, SLAT, difference is how we design the beneficiaries. What's the difference really about? SLAT versus the others, present access up to the borderline so we don't cause a state inclusion. We have to be careful because the SLAT, I don't want to accidentally cause a state inclusion. IDGT, I bypass that. I have the kids or other beneficiaries, nieces and nephews, whomever, they're the beneficiaries. It's definable, but I probably didn't do a great job for GST taxes on that. Because it breaks and they have separate shares, that's probably includable in their gross estates. Maybe I have to be a little bit careful on that. It's good for estate gift tax, GST, maybe not so much, depending on how it's designed. Dynasty trust, sturdy, durable GST tax planning. GST tax, generation skipping transfer tax. When I skip people, there can be a tax. So be careful. I've encountered lawyers make this mistake because they say, "Oh, I'm so clever. Like I had them, instead of gifting to their children, they said they're going to gift to their grandchildren because they just had a new grandchild." I said, "Did you calculate the GST tax?" And then they say, "What's that?" I say, "That's why you're going to have a malpractice claim." Is what that is. You have to be very careful because there's a tax that's quite complicated there to prevent you from doing that. So one has to arrange that. So that's those sets of trusts. Those, we're often thinking straight gifts. I just gift to those. Perhaps I'm using discounting because maybe I'm forming a family limited partnership or family limited LLC, putting the asset in there and transferring that. That structure, the family LPs, family LLCs, Nevada restricted LLCs, that's complicated with this kind of asset. Some companies do not like their company, their non-public company shares being held by these unique vehicles. Some are okay with it, some are not. Have to check. So going on to our next two, the GRAT and the sale to the grantor trust. Oh, no. Let's stay back to number 3, if we may. Yeah. So our middle one and sale to grantor trust. I mentioned before, I've had a lot of these companies not like the GRAT. They are worried about the GRAT, which is interesting because historically, a lot of planners thought the GRAT was safer. In the IRC, the Internal Revenue Code, the regulations, the GRAT is listed as a totally okay thing. They give you all the permutations of it. They say if you do the GRAT in this way, and you do everything like this, and you do all the calculations this way, you're you and me, taxpayer, IRS, we're cool. This is all right. And so planners liked it. But one of the things that seems to be in play is companies don't like this. And they're not particularly fond of the grad. What is the grad? The grad is, of course, this irrevocable trust to pass the growth on the assets to the next generation. But the initial gift and essentially interest on the initial gift goes back to the grantor. So this is a great vehicle. This is a great vehicle. So if, let's say, I have highly appreciable stock, and I have to say, gosh, the valuation, roughly presently is maybe it's just $10 million. And maybe just, I know this is Silicon Valley and you have your valuations are kind of crazy, maybe just $10 million. Thankfully, we're just $10 million. But I use it as an example because say $10 million, that's a lot of money, but not like crazy money. Because my wife and I actually only had about 6 to begin with, we were maybe less. And we'd be happy at 16. And even if that, doubles over our lifetime, we're going to be, under the 30 million. The concern that I have, Mike, I want the 10 million. But if that becomes 20 million or 30 million or more, I don't want that. I'm totally okay with that going to the next generation. But I'd be real happy, going, through my life and then into retirement with about 16 million. That would be nice and comfortable for me. I'm a happy camper. Well, the GRAT does that. The GRAT, I can throw the $10 million of the stock into the GRAT. The GRAT promises to pay the annuity back to my wife and I at $10 million plus interest. So I will get, over the term of the GRAT, I will get the 10 million back plus interest. And then whatever overage that's there, that stays in the GRAT. That falls into the GRAT. And the way that it works is, let's say, it's $10 million, it's 1,000 shares. The hope is, again, I throw 1,000 shares in. It pays me the $10 million plus interest in kind, in shares. It doesn't liquidate. It pays it in shares, and the shares go up in value. So I get less and less shares. Instead of getting 1,000 shares out, I get, far less. I hope, I get 800 out or so. And then the other, 200, that's in the trust. But the key thing with the GRAT is it then drops to adult beneficiaries immediately. So one of the challenges that people have not liked the GRAT is at the end of the term of the GRAT, the 10 years, 20 years, however it's structured, the kids get the stock. And so I have had parents say, well, gosh, I'll only be like 60 something, when that happens or so. I don't know if I want them to have the stock outright at that time. Also, Mike, I've seen your lectures before, this, divorcing spouses, creditor claims, tax problems. I don't want them to have it outright. I like the idea that, and this may be not a small amount of money. You always said it's better in the medium of the trust. What's with the GRAT? I said, well, I didn't create the GRAT. The IRS is the one who really, helped create the GRAT. They want it to drop in generation 2. They want it to be subject to estate tax again in that generation. They aren't applying GST exclusions to this. The GRAT has some downsides. So the GRAT has always historically had some downsides. The main thing is it passes to generation 2 and exposed to the taxes, creditors, risks of generation 2. We can copy the GRAT by doing a sale to a grantor trust. So you can get the same result by doing a sale to a grantor trust. So I create a grantor trust. I have to fund it with at least 10% of some assets. So I do have to make a 10% gift, but I can do that exact same thing. I can take the $10 million of stock, sell it to the GRAT, and the GRAT promises to pay me a promissory note based on various factors, the AFR rate, all of those things. And it will look like the GRAT. But I don't have the downside of it paying generation 2. It could be a dynasty trust. It can do all of these things. It could be a long-term trust for children. It has more flexibility than the GRAT. So very attractive on that. It also reduces the gift. So again, doing a GRAT or the sale to the IDGT, if I prime it with $1 million, because I need that for if I'm going to sell 10 million, it has to be primed with 10%. Well, I made a gift of $1 million, but I didn't make a gift of 10 million, because when I put in the stock and I sold the stock to the trust, it gave me back a $10 million promissory note plus interest at the AFR or above. So that transaction balanced. So I didn't use estate gift tax exemptions on that. I just used it for the first million. And I get to have the 10 million back, which I wanted to do. So sales to grant and retain trusts, very, very popular, very nice for that estate tax freezing technique. It solves that problem that we mentioned, like in slide 1 and 2, of overfunding the trust. I can avoid to some extent overfunding the trust, because I'll know at least I'll get 10 million. Okay, maybe it really balloons up and it ends up being 30 million. I put 20 million in and I only took 10 million out. Well, maybe that was more than I wanted to do, but if I was happy with the 10 million, I'm happy. So sale to grantor trust, that works. The sale to grantor trust works again because it's a grantor trust. This does not work well, and to some extent at all, with a non-grantor trust. So non-grantor trusts are more complicated. And then, of course, our little red thinking note, again, you have to make sure that this is all okay with the company. GRATs, recently not popular. Sales to IDGTs, less pushback than I would have thought. So, case by case, you have to check. So let's go on to number 4. This is over here with our QSBS. QSBS is another animal. QSBS being another animal, QSBS, the issue is we now are juggling estate gift taxes and the income tax with the particular issues of QSBS code section. So for this, we really have to, again, we're thinking about what's called QSBS stacking. I'm creating non-grantor trusts to multiply the per issuer cap. Each trust has to have its independent purpose, economic substance. It has to really have a specified beneficiary. They should be different. This is to, again, stack this exclusion so I can get 10 million free for me, 10 million for my son, 10 million for my daughter, 10 million, 10 million, 10 million. But these are non-grantor trusts. This works because they are separate taxpayers. So with this, we have to determine how are we going to fund these? And I frequently have situations where clients have to do both. They will be doing a tranche of non-grantor trusts and a tranche of grantor trusts, because different assets. And I probably don't want the assets that are not QSBS in the non-grantor trust yet. That's probably not a great idea. So it does sometimes cause some duplicative trusts or multiple trusts there. The other thing to remember, and we have a whole series on QSBS in our videos you can search for, but another thing to remember for QSBS is that states don't conform. California doesn't conform. So this is an issue that if you do a non-grantor trust, if you do it in California, you're still going to owe the California tax. So, possibly up to 1.3 million on your 10 million. It is not uncommon that we will do non-grantor QSBS trusts under the law of another state, but we don't take the position it's not California taxable. We allow the trust, because there's a California trust protector or something like that, we will say the trust is sort of broken as to the California trust taxing. So even though the trust is domiciled in Wyoming or Nevada, it has a particular break to cause California taxation. You say, Mike, why would you want to do that? You got it out of California. It's in Nevada. It's in Wyoming. It's a non-grantor trust. It's a completed gift, isn't it? And we have a contingent beneficiary. It's a dynasty trust. The beneficiary is not defined. Doesn't it pass all the tests to not be California? I said, yes, now, but what about the future? Is it certain? Does the family say, we are certain that when the kids grow up, they will not take a distribution from this trust while they are a California citizen, California resident? A lot of families say, no, we're never going to leave California. This state's been pretty good to us. We're never going to leave. Well, California has a throwback tax, and that could be very, very messy on these trusts. And the California throwback tax, there's no time limit on it. So that can be accumulating for 20 years, and I take a distribution. And as the distributee, I owe 20 years of back taxes on this. California really hates the non-grantor trusts out of state. So I have some clients that design them and say, you know what, let's just pay the taxes on it. What good is money that we can't spend? If I have millions of dollars in there, but I can't ever touch it if I'm in California where I actually want to be, that's going to be a problem. And do I really want my kids constantly hiding from the FTB, and claiming they live in Nevada or claiming they live, in, some other state, but then spending a lot of time in California? That's not good tax planning. That's probably, has some risk of blowing up. At the very least, you may get an examination. Whether or not you pass it will be, difficult. Some prefer not to go that way. So this is a further complication on what we were seeing before of if the startup company is a QSBS company, there is an additional wrinkle or consideration, because for these irrevocable trusts, there may be QSBS stacking in play, but that creates a very different looking trust that will limit things that are very common in IDGTs, like sales. QSBS non-grantor trust, that doesn't really work very well. The other thing that doesn't work very well, I should say doesn't work very well, but it's complicated. It works, but it is complicated, is the slat. You can do this with QSBS, but by creating a trust for my spouse per code, if my spouse is a beneficiary and my spouse can get distributions, that can automatically make it a grantor trust. So there are things you have to do to prevent that from happening, because you can accidentally break the non-grantor trust by imprudent beneficiary choices. So that's what I have for QSBS. Let's go on to our last slide over here, moving right along to some common problems. So this is a good thing for our last 5 minutes here. Some common problems here: waiting too long, getting too close to the deal being locked up. If you wait too long and let's say there's a binding MOU or there is a binding term sheet, discounts evaporate. QSBS, you have assignment of income issues. You have all kinds of problems that can cause issues for the valuation. The other thing, weak valuations. This is something that is, it's a hassle to me, though I have great respect for all of our appraisers, and with that, if you want quality, it's going to cost a little bit. You have to hire the appraisal. I know it's a hassle, but you need someone to do the work, and when they say the price per share is this, and they have a solid methodology, and they have a solid report, and they have a solid background, you avoid problems later. If you have some hokey thing or some do-it-yourself thing, or you hobby it, and you say, well, I guess it's the 409A, and I added I just got 30% more, because I don't know, 30 is a good number. Why not? It's got a 3 in there. You're going to get pushback. And that's another thing that can mess up the gift. And as we mentioned, these judicially created doctrines for funding the trust, you're not going to fall into those because you don't have a good faith appraisal. So weak appraisals are bad. Ignoring transfer restrictions, that could be real, that you're dead right out of the gate. Is you do all of this planning work, you do all of the work, you go to do the actual transfer to get it into the trust, the company says they won't do it. Problem. Botching the QSBS, problem. Doing QSBS stacking transfers to grantor trusts. I came across one of these earlier this year, and that was a huge problem. Like that was not actually the right kind of trust for that. It's great for estate gift tax purposes, but not QSBS stacking. So last one, doctrinal problems. Reciprocal trust. Wife does one for me, husband does one, or wife does one for husband, husband does one for wife. Reciprocal trust doctrine, problem there. Step transaction, that can be if we're one's being a little bit too clever. There can be problems with that. Assignment of income, that can be a problem. So again, that goes back to pitfall number one, waiting too long. So you want to again, be in this sweet spot of where there's sufficient slack to move, but there's some sufficient certainty that I know what I'm moving. So those are 5 common ones. So that hits us, we're about 10 minutes, actually about 12 minutes before. So we'll just go on to our last slide here, which is just our informational slide. So just, again, feel free to continue the conversation with me further by directly contacting me. That would be the best thing to do there. As you can see, and I hope the takeaway from this is that, wow, this is really complicated. And you feel that way because it is. This is the major leagues of planning. This is certainly not, what do I do with the rental house that's a free and clear rental house? And it's like, oh, well, just, charitable remainder unit trust, throw it in, sell it, get out of there. That's a little simple. This is, we're dealing with a lot of juggling. We're dealing with an asset that has a whole, you're dealing with the security side of the company. You're going to have to deal with that because you're going to have to do the transfer. Or the special purpose vehicle, if you're an investor, you're going to have to deal with that. There's a whole angle with that. Appraisals, there's a whole angle of appraisals. You're going to have to deal with that. How you fund the trust is going to be more complicated than just, dumping it in. You may be using another technique. And then the trust terms are going to be more sophisticated, more complicated, perhaps, likely because the values may be higher and the interest is more, or the size, the interest size is just a lot larger. So that's what I have for all of you. So what I will do, of course, I've got this all up here. They will send us to the webinar recording. You can see ways to contact us. Today, I'm actually not going to take live questions because this topic is a little bit too volatile for that. And I don't want people to accidentally be sort of identified if they start asking questions, because that can happen. And we had that happen once at a seminar that people kind of figured out who was asking the question. So we'll sidestep that, just chat with me offline. So it's been a great pleasure. I look forward to continuing success. This has been a great year so far. So I hope to see many more great things of this rising tide, raising all boats. So enjoy the summer, and we will see you for our next webinar in 1 month in July. Take care all. Goodbye.